Hello, and welcome to a crash course in mortgage lingo. First of all, I want to thank VCCDC and Union Bank for allowing me to do this presentation for you. So thank you, partners and VCCDC. In this course, what we would like to do is teach you mortgage lingo. You'll learn all of the different terms and how they're used and intermingled within our business. We're going to give you a better understanding of home buying, understanding most important terms like PMI and DTI, like what is that? And why is it good to buy? The last thing is our goal is to leave you better educated. So after you watch this course, we are going to leave you better educated than before you got here. As always, if you have any questions, you can reach out to me. My name is Veronica Dela Cruz, and I work with Union Bank, and I would love to hear from you. So let's get started. There are so many terms of mortgage. So take a look at all of these and let's see what you think. DTI, escrow, LTV, discount fee, DAP, CLTV, appraisal, home inspection, in escrow, PC, counteroffer, offer, EMD, 15-year, 30-year, flood cert, property taxes, supplemental taxes. I don't know about you, but I'm already getting a headache from all of this. TLTV, ADU, ARM, origination fee, fixed rate, termite inspection, conventional, FHA, VA, jumbo, hard money, broker, banker, direct lender, purchase price, loan amount, PMI, VA funding fee, PITI, and reserves. So as a first-time home buyer, or even as someone that is not in our industry, all of this information can be extremely overwhelming, and it's almost like a different language. So what I want to do is I want to take some time and just go over some of these things and give you a better overview and a better idea of what all of this means and what it means to you. So the first thing we're going to start with are basic qualifications, and we're going to use some of those terms that you just saw on that last slide. Basic qualification number one is DTI. What that means is debt to income ratio. So in real person-to-person terms, really what it means is it's all of your debt divided by your gross income. Your gross income is what you have before taxes. So for example, if you made $5,000 a month and you had a total debt of $2,500 a month, your debt to income ratio would be 50%. 50% for us is a little high, or for any lender, but you definitely want to talk to whoever you're speaking to see if you would qualify. Another thing, when I talk about total debt, that means any car payments, any credit cards, any installment loans, and of course, your new proposed mortgage payment. So that DTI is very important that you understand and that you speak with your mortgage consultant or your loan officer about. Second, down payment or down payment assistance, also known as DAP. So there are many forms of down payment assistance out there. VCCDC offers one. Union Bank actually offers two, which is a WISH program and a UB grant. Some people don't need any of that assistance and they would just put a down payment. The general rule for down payment is between 3% to 20% and all the way up. It's truly up to you. Remember, the more that you put as a down payment, the lower your mortgage payment will be. So if you have any questions regarding down payment assistance, reach out to VCCDC, reach out to myself, or reach out to your mortgage consultant or loan officer. They should be able to educate you as to any down payment assistance programs that they have, any that are within specific counties, or any that are in specific cities. So here's an example again. 3% down would be your contribution plus down payment assistance, which could be anywhere from $2,000 all the way up to $22,000, depending upon who you speak to and what you qualify for. Also, just a little reminder, anytime you look to apply for a down payment assistance program, Each down payment assistance program usually has their own requirements as to how they will qualify you. Moving on. Loan amount, that's a pretty easy one. All the loan amount is the amount of money that you're borrowing from the bank. Amount you are financing with your lending institution. Principal, interest, taxes, insurance, PITI. You will hear this a lot. This acronym, PITI, stands for Principal, Interest, Taxes, and Insurance. The principal and interest is actually the loan that you pay to your lender. So if you called me up and said, Veronica, I want a loan for $500,000. I said, okay, here's $500,000. Your principal and interest may be about $2,000 to $2,500. However, keep in mind that you also have to pay taxes and insurance included with your mortgage payment. So that is where we get the acronym PITI, because it stands for your total entire payment. PMI. A lot of people will hear about PMI. This is private mortgage insurance. Normally, PMI is added to your total payment when you put less than 20% down. So let's pretend that we have a house that's worth $500,000 and you put 3% down. That would be $15,000. So you have opted to get a loan for $485,000. That is far less than 20% down. Most places will require that you pay private mortgage insurance. What is private mortgage insurance, you ask? Private mortgage insurance is an insurance that you are actually paying on behalf of the bank that you are borrowing the money from. This is just in case something happens and you foreclose on your property, the bank would be insured. A couple of important factors to know about PMI or private mortgage insurance. On a conventional loan, once you reach that 20% equity of your original purchase price, you can actually call your lender and see if they will be able to take that private mortgage insurance off of your loan. That's a really great deal on a conventional mortgage. FHA works a little differently. They also have mortgage insurance. However, in order to get that taken off, you have to put a significant down payment or possibly refinance. Again, definitely speak to your own consultant regarding that, and they can help you better understand that. Savings equals reserves. That's another lingo that we use all the time. Oh my gosh, does your borrower have reserves? Do they have reserves? Reserves. What the heck is this, do you ask? It's just money that you have saved up. Sometimes lenders will require or like to see 2 to 3 months of reserves. What that means is that if your payment is, again, $2,500, 2 months of reserves would be $5,000. 3 months of reserves would be $7,500. This would be after you have already put your down payment and paid for all of your closing costs. There it is, amount of funds you have after you close. That means after you close escrow of the purchase of your new home. Speaking of escrow of the purchase of your new home, what does in escrow mean? In escrow basically just means that you are in contract. You have entered into contract with a seller of a home and you have decided to purchase this property. You would have agreed upon a purchase price. You could have submitted an offer. They could have given you a counter offer. And again, all intermingling with that, when you are in escrow, you are in contract for the purchase of said home. You would have renegotiated your prices, your closing costs, etc. with your seller. An appraisal is what will happen when you are in escrow. Appraisals are done to ensure the value of your property and safety hazard items are met per requirement by most lenders. So for example, let's say again, we'll use that $500,000. Let's say that you go into escrow for a property with $500,000 and tomorrow the market crashed. Let's say that today that house was worth $500,000 and tomorrow when your appraiser went out there, it was worth $300,000. That appraisal would come back. it would come back lesser than the $500,000, and it would basically tell you that if you wanted to proceed with $500,000, that you would be paying $200,000 more for said property. Of course, there are a lot of nuances in there. Again, speak directly to your specialist so that they can help you better understand that. Home inspection. When you are in escrow, a great idea would be to get a home inspection. This is not a requirement of most lenders. However, most buyers do opt for a home inspection because what does it do? It protects you and it does a deep dive into the actual bones of the property. So an appraiser is not going to go deep into your property and look at maybe all the electrical or all the plumbing or any funky things that are really, really going on way deep in there that they can't see. They basically do an overview. What a home inspector does is they go in and they check out all of the specifics of the property. They're going to crawl in under that house. They're going to go up into that attic. They're going to look all around to see if there's anything funky. You may be buying that $500,000 property, but maybe the plumbing's out, and that's something that the appraiser wouldn't have taken a look at, but the home inspector would. Home inspections run, I would say, between $300 to $500, but do not quote me on that. Make sure that you speak with your lenders to make sure that they are giving you the proper guidance regarding your home inspection. Termite inspection. Termite inspections are required on all VA loans. Some other loans do require termite inspections, and what this does is just inspects your property for termite infestation. This is up to you, and this is up to your seller. Going back up here to your counter and your counter offer and your offer, this is again dependent upon what you decide to do with your seller. Earnest money deposit, or EMD. What is that? Earnest money deposit is pretty much a good faith deposit of your funds. So basically, when you say, hey, seller, I want to buy this property, and they're like, really? Do you really want to buy my property? Let me see some skin in the game. They may suggest that you put 1% down, or $1,000 or $2,000. Again, that goes back to your offer and your counter offer. But once you do come to an agreement as to what your earnest money deposit will be, that is basically your good faith or your promise that you are going to proceed with the purchase of that home. The good news with that earnest money deposit is that that goes directly towards your down payment and it goes towards your closing costs. So it's not like it just sits there and the seller just takes it and puts it in their pocket. It goes directly to your bottom line. Your loan. So there are so many different types of loans out there, and there are so many different types of lenders. So what we're going to cover in your loan are just going to be a couple of little differences regarding those things. Basically, there are three types of loans. There's a conventional loan, an FHA loan, and a VA loan. Now, once you get up to the mega dollars, there is something else that's called the jumbo loan. But this is pretty much the nuts and bolts and what most people will use when they are purchasing a property. Conventional, FHA, and VA. They're kind of all the same, but they're also very different. On a conventional loan, for example, that's where you can get rid of your private mortgage insurance once you reach that 20%. On an FHA loan, you can put as little as 3.5% down. On a VA loan, thank you veterans, you can get up to 100% financing. So what type of loan is good for you? You definitely need to speak with your loan specialist so that they can educate you on the differences in length, and then you will be able to decide what type of loan is best for you. What is an origination fee? An origination fee is one of the closing costs that is incorporated when you finance a transaction with a bank. An origination fee could be a processing fee, an application fee, or it could be what are called points. In general, from what I've seen in my experience, most bankers, brokers, direct lenders all charge around the same thing. The differences that I've seen are what they call them. They will call an origination fee a processing fee, an underwriting fee, an application fee, or they may say, I'm going to charge you a point. which gets to my next. What is a loan discount fee? You might see this on one of your closing disclosures, and a closing disclosure is a line item of what you are paying for your loan. Please be aware, a loan discount fee is not a discount. No one is giving you a discount. What a loan discount fee is it's actually points that you are paying to buy down your interest rate. For example, if you buy that $500,000 home and your rate is 3.5%, and you see a loan discount fee of 1%, that means that you are paying $5,000 to get that 3.5% rate. Most places don't really like to charge loan discount fees. We don't want you to pay all of that money for a loan. We try to get you the best deal as possible. And I think I can say that for all of the people that are involved in this VCC housing fair. An impound account. What is that? It's also called an escrow account. What an impound account is it's your taxes and your insurance that you pay monthly. What that does is the bank actually puts that in an account for you, and when your insurance is due every year and when your taxes are due every 6 months, they take that money that they saved on your behalf and they pay that bill for you. Do you always have to have an impound account? No. In the state of California, if you owe 89.999% or less, you are not required to have an impound account. This differs with every single lender and every single loan. However, for the most part, that is the general rule. Your total payment, again, includes your principal, your interest, your taxes, and your insurance. Now, just because you decide to not have an impound account and pay me only the principal and interest, or pay your bank only the principal and interest, that does not mean that you are not liable for taxes and insurance. All that means is that you've decided to save that money on your own, and the bank will not be paying those on your behalf. Also remember, what is included in your payment is private mortgage insurance or mortgage insurance if you are putting less than 20% down. Keep in mind that when you are talking to a lender, please make sure that you ask for the total payment. Even if you're not going to pay your taxes and insurance with your payment, you want to make sure that you know what your entire payment is going to be for your mortgage. Closing costs. Again, we went over a couple of things up here, like origination fee and loan discount fee. These are all parts of doing a loan. There are so many people involved in one transaction and so many companies. Off of the top of my head, there's a loan officer, there's a bank, there's an escrow company, there's a title company, there's an appraisal company, there's a home inspection company, there's a notary, there is a processor, there's an underwriter. There are so many people involved just to make your dream of homeownership come true. What happens with that is that there are fees that are involved with that. And that is where you will see, again, your line itemization of closing costs. Another thing that is involved in closing costs are your prepaids. Prepaids are, again, your taxes and your insurance and any interest that you pay on a loan. When you look at your itemization, please make sure that your closing costs and your prepaid items are included. Many times I have seen where people think that their closing costs are only $5,000, but they didn't add on those prepaid items. Normally, we will collect 6 months or so of your taxes and about a year of your insurance. So that makes a very big difference, especially if you're going and trying to negotiate with the seller to see if you want them to pay for your closing costs or not. Again, speak with your realtor and speak with your lender to ensure that they are educating you correctly. Other terms in the industry that you might run across: escrow. Again, we touched on that. Escrow is a third-party company that handles all funds. The reason that you pay for an escrow company is that you don't want to give me a check for $5,000. You don't want to give your realtor a check for $5,000. The escrow company is a non-interested third party, and what they kind of do is they make sure that everybody's running all the numbers the way that they should be. It's there to protect you, the consumer. Title. A title company, they make sure that there's not a cloud on your title, or they make sure that there's not like some sort of funky lien that will pop up. For example, let's say you buy that $500,000 house, but then let's say like there's this person that comes over and says, hey, I have the deed to this house. This is my house. Your purchase is null. That's what you pay a title company for. The title company ensures that nobody's going to come out of the woodwork and they're not going to say that they own your property that you just bought yesterday. They also make sure that there are other funky little things that are not going on with your property, like any other liens, maybe a tax lien or some sort of lien with the city. Again, that's what a title company is for, to make sure there are no clouds on your new purchase of your home. Supplemental taxes. This one is very, very important. In the state of California, your tax bill is 1.25% of your purchase price. However, let's say you buy that $500,000 home and in a few years you add some square footage to that. Guess what's going to happen? That property will be reassessed with the more square footage and you will be assessed a supplemental tax bill. So your taxes are going to go up. Some other types of supplemental tax bills could be for new schools in the area or community improvement in whatever area that you are purchasing. A lot of places in Ventura County have what's called a Mello-Roos tax. Make sure that you speak with your lender and your realtor so that you know exactly what kind of taxes you are up against when you purchase your home. What's the difference between a broker, a banker, and a direct lender? I like to use this adage a lot. They're different, but the same. Almost everybody offers a conventional, an FHA, and a VA. Brokers, bankers, and direct lenders can offer specific niche products that may suit your particular needs. Every single buyer has a different story. Every single buyer has a different income story. So definitely speak to all three so that you are educated and you know what person, what bank, what direct lender, or what broker best suits you. Jumbo loans. We touched on this about 5 minutes ago. Jumbo loans are loan amounts that are above our county limit of Ventura County, which is $739,450. So once you get into the buco bucks, you fall into a completely different category. Jumbo loans are what are called portfolio loans. Pretty much what that means is that the bank, me, Union Bank, or any other place that you go to that offers jumbo loans, they hold the paper on the loan. Their guidelines are slightly different, sometimes better, sometimes worse. Again, speak with your specialist and ask about a jumbo loan if you're looking into that market. Well, again, I want to thank you and I want to thank VCCDC for the opportunity to serve. And I would like to thank all of our other partners that are involved in this, and good luck to you in your home buying process.